In the year 2020, we had one of the quickest and sharpest market crashes that we'd ever seen. The S&P 500 fell 31% in just 1 month, and shortly thereafter, most countries in the world went into a recession. But what we've seen since then has surprised most investors. Instead of the market taking years and years to recover, in a matter of months we were back to previous price levels, and the months after that we were reaching new stock market highs. These prices, some predicted we wouldn't see for a decade. We had seen a recession spread throughout the world, a great pandemic hurting businesses, but stocks were at all-time market highs. Investors were richer than they'd ever been before. This has left a lot of people wondering if we've simply delayed the next market crash until later on in 2021. A crash that could potentially be worse than the one we saw in 2020. What we'll do in this video is go over the different market crash indicators and assess the likelihood on a crash occurring this year. First indicator that I always like to go to is the Warren Buffett indicator. The Buffett indicator is Warren's favorite way of assessing where valuations are in the market. If we take a look here, we can see that the Buffett indicator is currently ridiculously high. It's sitting at 227%. That's 80% higher than the historical average fair value line. This is the highest that it has been over the past 30 years of this graph. Higher than what it was in the 2008 housing bubble, and even higher than what it was in the 2000 Great Internet bubble. Back then, it was 67% higher than the fair value line. Today, we're sitting at 80% higher. This is a graph that should make many stock investors question their assumptions. 227%. This means that the market value of all stock prices are over 2 times higher than what they produce, the GDP. Historically, we have not seen this before, at least not over the past 70 years. That's as far back as I can get the data on. But let's look at some more indicators. One of my favorite indicators of all time is the 10-year Treasury minus the 2-year Treasury, because it's so consistent at predicting a crash. Whenever this graph inverts to below zero, it is one of the strongest signs of a recession. If we go back to 1989, it inverted below zero, and a year later we saw a recession. In 2000 we saw it invert, and in 2001 we had a recession. 2006 it inverted again, and what do you know, 2 years later we got hit with a great recession. Then most recently in 2019 we saw an inversion, and obviously we've just been through a recession in 2020. Now, if we take a look at this indicator, it's actually gone up since the 2019 inversion, up by a lot. It's currently sitting at 1.46. 1.46, that's nowhere near close to another dip. This means that according to this indicator, we will not see another recession soon unless we see a double recession from the previous dip in 2019. That's a total possibility. So why is it that whenever we see this indicator dip below zero, that we almost always see a recession? I believe it's predicted the past 8 out of 10 recessions and 80% success rates. It's because investors are worried. The market is shaky and people will take any low interest just to lock their money away for 10 years. So much so that they will take a lower interest in a 10-year treasury compared to a shorter term 2-year treasury. They just want their money stowed away for a long time, not in something that could potentially crash soon like the market. So 10-year treasury minus 2-year treasury, that's always a good indicator to pay close attention to. Another thing that any smart investor should be looking at when analyzing the chances of a crash is the S&P 500 PE ratio. Basically what this metric does is it compares the price to the earnings. Now, the average PE ratio across time is 15. Anything above that means prices are higher compared to the earnings that they normally produce. As you can see right now, we're sitting at a PE ratio of 44.6. This is higher than what they were in the 2000 crash, but not quite as high as the 2008 one. Still, 44.6, this means prices are almost 3 times higher than the average across history. But some experts say no, you shouldn't look at the PE ratio because this calculates earnings over the past year and it could be a one-off irregularity. They say look at the annualized PE ratio across 10 years, aka the Shiller PE ratio. This way there can't be any one-year irregularity because it measures earnings over 10 years. So let's look at this ratio. The Shiller PE also reads high. It's currently sitting at 37.2, that's above the 2008 bubble, but not quite as high as the 2001. So either metric that you look at, Shiller or not Shiller, they both point towards one thing, and that is that prices are sky high right now. This, I believe, is a strong reason why we're seeing so many wealthy investors selling when it comes to their portfolio. Bill Gates sold 14 stocks this recent quarter in 2021, and he bought just one. Warren Buffett sold more than he bought as well. He sold 13 stocks, and he bought 5. Bill Ackman, same story, sold 6 stocks, bought just 2. Now, not every billionaire investor has sold more than they bought, but a lot of the big names have, and the fact that prices are at all-time highs will certainly be one of the reasons why they're selling. But also because all of the speculation that's going on in the market, all of this money that's going in and out of cryptocurrency, in and out of meme stocks and meme coins, this is often a signal that a crash may be on its way. Now, I have a unique opinion on these cryptocurrencies and the speculation. A lot of my audience say, stay away from it at all cost. I say, yes, these things are risky, but there's also plenty of opportunity in them. I compare it to the wild, wild west, where yes, it was very dangerous, you risked a lot, but also there was a lot of potential to make money. They could start a business and grow and expand and click, you had wealth. Cryptocurrency is the same thing. Yes, a lot of people will get burned and lose money, but on the other hand, a lot of people will profit strongly. Either way, these types of speculative activities is often a signal that a market crash is on the horizon. Just like in 1999 where everyone speculated on different technology companies, we saw a crash a year or two later. So, will a market crash come in 2021 or the next years following? There is still a good possibility. If you look at all of these indicators, they point towards prices being very high, almost not sustainable. But why are prices so high right now, and why haven't we seen them fall back to more appropriate levels? Pause the video and see if you can guess the answer. But the answer is ... interest rates. Interest rates are incredibly low right now, which causes stock prices to go higher. As Buffett says, interest rates basically are to the value of assets what gravity is to matter. If rates are low, no one wants to have their money in the bank, they hardly get any return, so they have it in the market. If interest rates are high, people take their money out of the market and put it into the safety of treasuries with higher rates. And right now, as you can see, rates are astoundingly low. They're the lowest that they've been in a long, long time. They're sitting at 0.25%. Pretty much meaning if you have your money in the bank, you'll get nothing in return. So everyone's chucking their money in the stock market. The risk comes when the Fed starts raising rates. Then I'd be very much on my toes when it comes to a crash. So how do we prepare for this crash that may be on the horizon, but also it's not guaranteed? Either way, we should be ready. One interesting thing that I noticed Bill Gates doing, whether it's to prepare himself for a crash or whatever, but he's buying up farms. Bill Gates is now the largest private owner of farmland in the United States with approximately 242,000 acres of it. Farms are a smart investment because in a recession, we still need food. Also, farms are a finite asset that will always be in demand. Now, I'm not saying that we should all be doing the same thing and buying farms like Gates. Most of us, myself included, cannot afford acres of farmland. What we can afford, however, is buying farm stocks. Bunge Limited, Farmer Brothers Company, Sanderson Farms, Farmland Partners. These are all stocks available for tens or hundreds of dollars, affordable to pretty much everyone. A strong conservative investment over the long term, good for tough times. If we take a look at Warren Buffett's way of preparing for a crash, he's a big proponent of holding cash. He views it as a type of gunpowder necessary for when a recession or a crash hits. Because if you don't have any cash on you, one thing's for sure, you won't be able to buy stocks when they're cheap. Buffett currently has $145.4 billion of cash on him right now, and I'd recommend that you do the same. Just find $145 billion and you'll be fine. Okay, just joking, $145 billion out of his $700 billion portfolio is 20.8% cash. That's quite a bit. I generally prefer holding less of a percentage, but either way, everyone does need some amounts of cash on them if they wish to profit in a recession. And then of course we can't forget the other classics of preparation. Gold, consumer staple stocks, and bonds are other ways that wealthy investors prepare for a recession. So go throughout your portfolio, let me know in the comments what ways you are prepared for the next recession and next market crash.